will review the highlights, answer your questions, and offer suggestions on how companies can get the most from the results of the American Supply Association's 2014 Operating Performance Report, or OPR. Please note that this one-hour webinar is being recorded for replay. Everyone registered for this webinar will receive a follow-up email message with notification as to when the replay is available, as well as instructions on how to access it and the presentation slides. I'm Chris Murin with ASA, and before we get underway, I'd like to be sure we recognize our 2014 supplier partners who are truly dedicated to the positive development of the PHCP and industrial mechanical PVF industry through ASA. When making key decisions in your business, please consider these corporate partners that go above and beyond with their support to advance the association's efforts, programs, and services through advocacy, education, networking, and benchmarking. One of the association's strategic goals is that ASA members will be more profitable and sustainable as they deliver world-class supply chain efficiency in a changing marketplace. For more than 30 years, ASA has partnered with Industry Insights Incorporated to provide the only source of industry-wide financial and operating performance benchmarks for the PHCP and industrial mechanical PVF wholesale distribution channel. Today, the annual OPR is part of a total suite of business intelligence reports that provide ASA members with reliable and timely industry data to use when making strategic decisions that fuel growth. ASA also partners with Industry Insights to produce a monthly flash report on profitability, sales, inventory, headcount, and average day sales outstanding, as well as confidential business valuation appraisals. It's now my pleasure to introduce our presenter and an all-around good guy, Tom Noon, who founded Industry Insights back in 1980. Tom's expertise primarily includes the areas of financial analysis, business valuations, profitability planning, and productivity improvement strategies. He has served as project director in a variety of research and consulting studies for both U.S. and European public and private firms, as well as numerous trade and professional associations. Additionally, Tom has played a major role in both the design and presentation of executive development programs in the United States and Western Europe. And if you read the Wall Street Journal, U.S. News and World Report, and a number of other trade magazines, you may even recall seeing him quoted. Now, before I turn it over to Tom, I want to make sure that everyone is clear he or she is encouraged to ask questions throughout this presentation. While it would likely be very difficult to have all of us on a conference call, your go-to webinar control panel includes window panes in which you may pose questions and even chat with other participants through the use of your computer's mouse and keyboard. I'll help Tom to monitor the control panel for your questions, and periodically he'll ask us if we have any for him. By the way, you can minimize and maximize the go-to webinar control panel on your screen by clicking on the orange arrow in the upper left-hand corner. Tom, why don't you get us going?
All right. Well, thank you very much, Chris. First of all, I'd like to say how very pleased I am to be here with you all today, and I'd like to thank you all for taking time out of your busy schedules to go through this year's ASA Operating Performance Report. As you probably all know, the OPR is a benchmarking kind of study, providing you with all kinds of barometers against which to compare your own company's performance. So the value of this study is how you compare versus your industry peers. So what I would like to do in the session today is spend some time talking about, at the outset, why this information is important, but then get into actually showing some of the results of this year's study, recognizing that, again, the value is how you compare to these industry numbers. Also, I'd like to spend some time talking about some of the new features of this year's study. Each year, we try to evolve the study based on comments that we hear from you, the members, and we have several new features this year that are worth highlighting, and I think it's important to point them out because sometimes these things get missed in the vast amount of information that's in the study. I'll get into actually showing the results of the study, but sort of as a backdrop to that, I'll spend some time talking about the economic climate and just show you a few snapshots of where we've been, where we are today in terms of the economy, because that has such a big impact on the overall profitability of companies in the industry. Also, I want to do something that I typically do in a session like this, and that is take a look at the profit leaders or the high profit companies. This is something we do pretty much every year, but it's important to do it because the numbers change, and it's important to see if the components that lead to high profitability change over time or if, in fact, they are consistent from year to year. So we'll take a look at the high profit companies. In particular, we'll look at plumbing supply companies, all companies versus the high profit companies, and we'll also look at PVF companies, all PVF companies versus the high profit PVF companies. Then towards the end of the session, I want to spend a little time talking about what I call partners per profit distributors and suppliers. And in particular, what I'm talking about here is you are really partners with your suppliers. And I think sometimes there is an adversarial type of relationship that builds up between a distributor and their vendors because you have really different objectives. Your vendors probably want to try to load you up with as much product as possible, but you as the distributor probably are trying to get the best price as possible on your purchases. Well, I maintain that if you take more of a partnership type approach and understand each other's business a little better, maybe you can together plan for your own future success and create a win-win for both of you. So I want to talk a little bit about that, and sort of within that, take a look at the changes that have occurred in the industry over the past 32 years. This is the 32nd year that we've now done the OPR. So that's where we're heading in the session. And as Chris mentioned, if you have any questions, by all means type them in the question bar, and he'll break in, and hopefully I can answer them. If not, we'll try to answer them afterwards. Okay, as you probably know, the study includes two separate reports. There's an overall industry-wide report that has all the data and all the data groupings as well as some analysis. It also includes ratio definitions and other information in there. And then in addition, there is the confidential company performance report. And I say confidential because this is a specifically generated report about your own company. It shows your own company's financial and operating ratios alongside that of the comparisons that are most like yourself. So if you're a large company, there'll be comparisons of other large companies. If you're a small company, vice versa. It'll show you if you're you versus other plumbing supply companies, if that's the specialty that you're in. If you're a PVF company, it'll show you versus other PVF companies. So this is a very useful tool for you, hopefully, to really narrow down where your strengths and weaknesses are. Now, for the first time ever, both of these reports are being made totally electronically for you or to you as PDFs so that you can print out as many copies as you want. We've received that comment many times in recent years. Why can't we just have an electronic version of these studies so that we can print them out and hand them to some of our key people? And so for the first time this year, you have that capability. Okay, well, why is this information important in the first place? Why is financial ratios important? Well, you've probably heard me say this before, but it's worth repeating, and that is just to look at the dollar amounts of it's on your P&L or income statement doesn't tell you all you need to know about your business. For example, if you said, Tom, we had a great year last year. We had $200,000 of profits. Well, I don't know if that's good or bad. If you did $200,000 of profits and you're a $2 million company, that tells me one thing. If you did $200,000 of profits and you're a $20 million company, that tells me something totally different. A 10% profit on sales is much different than a 1% profit on sales. So that's why it's useful to look at a financial ratio, one number compared to another number. Well, just as looking at the dollar amounts doesn't tell you all you need to know, neither does looking at a financial ratio all by itself. You need some sort of comparison, and that's where the OPR comes in. It provides you with benchmarks versus other industry peers. Now, that's not your only comparison that you have available to you. You can also look at your own company's historical performance over time, and that's also a very good gauge for how you're performing, because obviously there's no industry peer that's truly an apples-to-apples kind of comparison for you. So really, I suggest that you look at both as you versus your industry peers and yourself over time. Well, the value of this study is we also provide historical information in the confidential company performance report, so you can see your own trends over time, both in graphical and tabular form for all the various ratios in the study. So if you see something out of line over time, then that hopefully will raise a red flag and maybe provide an opportunity for improvement. But keep in mind, the information in the study really is to serve as guidelines. It's just to help you raise red flags of areas that might need further attention. If you see something out of line, it's not necessarily good or bad, but it's something you need to understand why you might be different. And I maintain that you don't have to be a financial expert to use this information. Yes, it may be overwhelming when you first see it. It's a great deal of data. But it's hopefully designed so that you can easily make your comparisons versus your company. You can look at some key measures initially, let that dictate other things to look at in more depth. And if you see something out of line and you know why it's out of line, then you're probably in good control and it's probably not a problem. But if you see something that's out of line and you don't know it, then maybe that will lead you to an opportunity for improvement. Well, the study has a great deal of information. It's very comprehensive. There's return on investment information. There's percentage income statement and balance sheet information. There's expense detail, gross margin information, asset and financial information. There's financial healthiness information, such as the Z-score, personnel and inventory productivity information, et cetera, et cetera. So it tries to give you a lot about many different aspects of your business. Then in an attempt to try to get as close as possible to an apples-to-apples kind of comparison, the data is broken a number of different ways so that hopefully you can find data groupings of companies most like yourself. There's the all responding firms grouping, which is probably the least useful because that's useful for telling us how the overall industry did. But for you in looking at your own company, you want to get down to companies most like yourself. So you might want to look at companies in the similar sales volume category as you. You might want to look at companies of similar sales emphasis as you. For example, if you're a plumbing supply company, look at yourself versus other plumbing supply companies. PVF, look at yourself versus other PVF companies. And within each of those, the data is broken down by sales volume. There's also that high profit company data grouping within each of the sales emphasis specialties. And the way we define the high profit companies is this is the upper 50% most profitable companies based on one measure, before tax return on assets. So we just look at one measure, break up the top half most profitable companies and put them in a group by themselves, then run all the data for that group of companies in order to see where they've excelled and where it wasn't all that important that they didn't do as well as other companies in the industry. So that's also a very useful grouping. We also have information that's by number of branches, and then in your own individual report, we have a grouping of companies in your same geographic region. This only appears in your own individual report. So you can compare companies versus others in your individual report. So it's a very comprehensive study. So that's sort of the good news. The bad news is that because it's so comprehensive, it can be overwhelming. But hopefully, by seeing a session such as this and using it a little bit, you will over time become very comfortable with it. Okay, what's new in this year's study? Well, sort of a major change in this year's study is that for the first time in the 32 years that we've done the study, we are now including purchase rebates as part of gross margin. So in other words, this goes above the operating income line. It's part of gross margin, which increases the overall gross margin for a company and increases your operating income. So this shows up differently on the balance or the P&L statement, the income statement, than it ever has in the past. The reason for this change is that historically purchase rebates or vendor rebates really weren't all that significant. But over time, they've become more and more significant. They're almost 5% of sales for the typical company out there. And as a result, most companies put it as part of gross margin now, and we have for this study as well. So the P&L or income statement looks different than it has in the past. Also, as I've already alluded to, we've gone electronic for you, for your benefit, so that the individual report and the industry-wide report you receive as a PDF, and you can print out as many copies as you want. In addition, we have a new ratio called employee turnover, and this came as a suggestion out of some of the members that it would be an interesting thing to look at. So we have a ratio called employee turnover, and it's defined as it can be defined many different ways, but the way it's defined for purposes of the study is it's the percent of full-time equivalent workers employed at the beginning of the year who left the company during the year for any reason except retirement. If you want to see that definition in print, it's on page 71 of the full industry-wide report, and I refer you to that because there's a little example also of how it's calculated. But that's the definition, and it's a useful new measure, I believe. Okay, let's take a look at some of the information or some of the results of this year's study, and as I said, as a backdrop to that, we'll take a look at what's happening in the economy, and I just want to sort of go through this fairly quickly, give you some snapshots of the economy. This first slide here is gross domestic product after adjusting for inflation. No surprise, you can see the economic downturn, how significant that was. We've come back since then, but it's been a sluggish recovery. In 2013, real GDP only increased by 1.9%, so still nowhere near what we want it to be. But when I see a slide like this, the thing that comes to my mind in all my years of experience that we all have to keep in mind is that the economy goes through cycles. It always goes through ups and downs. It always has. It always will. So how that translates for you in managing your own business is if you do the best job of managing your business regardless of what's happening in the economy, you're going to get the most profitability possible regardless of what's happening. Okay, this is the same measure, gross domestic product, in real or inflation-adjusted terms, but it's based on a quarterly look at it. And in each of these represents the percent change over the prior quarter. And you can see that ever since the economic downturn, we've had some sort of a up and down sort of pattern, but again, overall, sluggish economic growth. As a matter of fact, the first quarter of 2014, we had a decline of 2.1%. It came back significantly by the preliminary numbers for the second quarter, a 4% increase, but the net result is it's been relatively sluggish. Okay, this particular chart shows the Conference Board Index, and there's a lot of information on this. The only real things you need to worry about is the shaded lines represent periods of recession, and the dark blue represents the Conference Board Index. And this is an index of consumer confidence, and it's a good measure of where the economy is going because you can always see that it goes down significantly during an economic downturn. But most notable is that this index just in this most recent month finally hit an index of 90. That's significant because the Conference Board tells us that you need a 90 consumer confidence in order to start approaching a stable economy. And this is the first time that we have gotten to that level since really 2008 or so. So seeing some progress, but still very sluggish recovery. Real wholesale sales or inflation-adjusted wholesale sales, again, you can see a significant impact of the economic downturn. It's come back somewhat, but the last 2 years, 2012 and 13, if you look at all wholesale sales, has been sluggish. Inflation in the overall economy, as measured by the gross domestic product deflator, fortunately has been under control, largely due to the sluggish economy actually, but inflation at this point in time hasn't been a significant issue. Unemployment rates reached a high of 9.6% in 2010 on an annual basis. They've come down since then. The most recent unemployment rates for July of this year, 6.2%. There has been a lot written, however, on the fact that unemployment rates are somewhat understated because workforce participation rates recently hit the lowest level in 40 years, but the fact is they have come down somewhat. The prime rate has been at the same rate, 3.25%, seems like forever, which is interesting because way back in this period, in the mid 2006, 2007, the Federal Reserve was actually raising interest rates. As a matter of fact, they raised them like something like 18 or 19 consecutive monthly meetings, because the economy was kicking up and they were worried about inflation, but not much has happened in terms of interest rates for a long time. Okay, with that backdrop, let's look at what's happened in terms of industry performance. And what I want to do is take a look at a number of charts that all look alike in terms of the way they're laid out. So hopefully once you figure out the first one, it'll be easy to figure out the remainder. And each chart's going to take a look at one measure. This particular chart looks at before tax return on net worth, and this is for all responding ASA firms. So this is sort of a broad look at what's happening for all companies participating in the OPR. And you can see in terms of overall profitability, basically the industry has come back consistently every year since the economic downturn. And the most recent year, the typical company showed a before-tax return on net worth of 16.6%. Another measure, net profits before tax as a percentage of sales. So this is bottom line profits as a percentage of sales. And you can see this is what's driving that previous chart being return on net worth, this being profit margin on sales. You can see how profit margin has consistently over the last 5 years increased as the economy has gotten through this recession and has gotten back on its feet again, the industry. So the typical company in 2013 was at 3.5%. Asset turnover. This is sales divided by total assets. It's a measure of how effectively you use your asset base to generate sales. And this has been very consistent over the years, even during the economic downturn, very consistent. Financial leverage, which is how much the typical company relies on debt versus equity financing. And you can see also this has been fairly consistent over the years, right around 1.8, 1.9 times for the most part during over the last 5 years. It did dip down a little bit when we had the economic downturn, or just coming out of the economic downturn. And I think that was largely due to the fact that people were so scared they just got very conservative in the way they financed their businesses. Payroll costs. This happens to be an extremely important measure. This is payroll, including fringe benefits, as a percentage of net sales. It's important because your payroll costs are a significant expense item for most all of you. The interesting thing is it's been relatively steady over the last 5, 6 years. Ticked up a little bit during the economic downturn, but been very steady over the other years. This is an important measure not only because it's a significant amount as a percentage of sales, but for the typical company, it represents over 60% of gross margin dollars that go to payroll costs. So it stands to reason that managing payroll costs are critically important. And when we take a look at the high-profit companies, we'll see that they consistently have lower payroll costs as a percentage of sales. They typically do a better job of managing their people. Gross margin on net sales. As I mentioned to you, this is a measure that has been changed in this year's report, although we sort of still show it both ways. Historically, through the years, we did not bring in purchase rebates into gross margin. Purchase rebates were always considered a non-operating income item and were put below the operating income line. As a result of that, as purchase rebates became more and more significant over the years, companies actually were showing a negative operating profit if purchase rebates weren't a part of gross margin. So many companies over the years started putting it as a part of gross margin. Well, gross margin with purchase rebates added back in this year were 27.2%. Historically, we didn't have it in, and so we're showing you the historic numbers here where purchase rebates were not included within gross margin. And I think the point can be made is the gross margin over the last 5 years has declined somewhat. It's gone down every single year over the last 5 years. And that's significant because obviously that has an impact on company performance. Inventory turnover. This is warehouse cost of goods sold divided by average inventory. And it's sort of been up and down over the years. When we were just coming out of the economic downturn, inventory turnover, not surprisingly, was the lowest it's been in a while. And it's been coming back. It's gone up from last year to 3.8 times. And so that obviously helps offset the declines that we've seen in gross margin or gross profit, interchangeable terms. And as a result of the fact that inventory turnover went up even though gross margin went down, the measure that is a combination of the two, which is called gross margin return on inventory, or GMROI, stayed relatively similar from 2012 to 2013. What this measure is it's a combination measure that combines both inventory turnover and gross margin percent into one overall measure of inventory productivity. So a way to interpret this is if you see 112% in 2013, that means that the typical company earned $1.12 in gross margin dollars for every dollar invested in inventory. So they had 112% return on the inventory investment. That's what that tells you. And the beauty of this measure is that you can have a company that's a high turnover company and a low gross margin company, or vice versa. You can be a low turnover, high gross margin company and still get to a good GMROI. Okay, total operating expenses as a percentage of sales. That's also important because, again, when we take a look at the high profit companies, we'll find, again, and this happens every year, that they have lower expenses as a percentage of sales than other companies overall. And on a very positive note, operating expenses as a percentage of sales have steadily declined over the last 5 years. And a part of that clearly is the fact that when we were in the midst of the economic downturn, people's fixed expenses were spread over less sales because sales actually declined for the typical company, which caused overall expenses to be high. Well, as sales have come back somewhat, operating expense or fixed expenses are spread over more sales, and operating expenses actually have declined somewhat. And I think companies also during the economic downturn sort of tightened their belt, became very expense-minded, and emerged out of the economic downturn much leaner and cleaner, if you will, than going into it. Average collection period on receivables. How long does it take the typical company to collect their accounts receivables? This is also called days receivables outstanding, and the typical company in 2013 was at 46 days. Now, as I go through all these numbers, keep in mind it's nice to know that how the industry did, but what's most important is how you compare to your peers in the industry. So, like for example, let's looking at this ratio. If you see that your receivables management or your receivables days outstanding is much higher than the typical company in the industry, then that raises a red flag as to something you might want to look at in more depth. You know, maybe there's a very good reason for it. Maybe you've specifically decided to have very liberal receivable collection strategies or terms, which you feel helps your sales, but you knew your receivables days outstanding would be higher. If you would tell me that, then I'd say, fine, you are in control, you knew what you were doing. But if your receivables days outstanding have crept up over time, when you look at your history and look at you versus the industry, and you didn't know that situation was happening, then that may be an opportunity for improvement. Net sales per employee, how effectively you utilize your employees to generate sales. This has gone up over the years for the typical company in the industry. It was $438,000 in 2013, and this is not inflation adjusted as you see it on this chart. So by definition, you're going to have some inflation in this, where this will probably go up just due to inflation alone. But this is also a good measure to compare yourself versus your peers in the industry. Are you getting the productivity out of your people that other companies get? Percent sales change from the previous year. You can see again the economic downturn was very severe. Typical company showed a 17% decline in sales. If we'd put the previous year on that, that was another 2% or 2.2% that occurred in 2008. And then we've come back, but interestingly, if you add the 17.2% decline versus the 2.2% decline in the previous year, so that gives a 19.4% decline over the 2 years there, and you start adding up the 3 years here, or the 4 years here, it wasn't till really sometime in 2013 that the typical company in the industry got back to volume levels that existed back before the recession or in 2008. Okay, we've looked so far at all companies. Let's take a look now at some of the segments in the industry. In particular, I'm going to show you a series of charts that, again, look at one measure each. This particular one looks at before-tax return on net worth, and we'll take a look at plumbing supply companies, PVF companies, plumbing supply and PVF, and HVAC and other. And as you look at this particular chart, return on net worth profitability, you can see that in 2013, typical PVF company actually was the most profitable of the 4 segments there, with a 20% return on net worth. Interestingly, however, if you look at bottom line profit margin on sales, the plumbing supply companies actually did somewhat better than did PVF companies. And you can see how the other 2 segments did as well. Also interestingly, even though the PVF companies were the highest return on net worth profitability overall, they happen to be the lowest in terms of gross margin on net sales after purchase rebates, with a 25.6 versus 27.6, 27.7, 27.8. So the PVF companies got their overall return on net worth through something other than gross margin or bottom line profit margin on sales. Inventory turnover, however, did favor the PVF companies. They showed a 4.2 times inventory turnover, which is warehouse cost of goods sold divided by average inventory, which was the highest of the 4 segments there. And then if we look at that combination measure for each of the 4 segments, which is warehouse gross margin return on inventory, or GMROI, the PVF companies, even though they had lower gross margin, they had high enough inventory turnover to lead to them being the highest in terms of overall GMROI as compared to the other segments. And again, it's nice to know how the industry did, but what's most useful is how you compare to the industry. Now, I'm sort of going through all these ratios here. I'd like to also bring to your attention that in the back of the full industry-wide report, the ratios are defined, so that if there's a particular ratio that you don't really understand how that was defined, then there is a definition provided for you there for your reference. Employee turnover, this is that new measure that we have this year, And looking at the segments there, it's plumbing supply firms had a 9% employee turnover based on how we defined it. PVF firms were at 6. The highest was plumbing supply and PVF together, and HVAC and other were at 7. Again, that's defined as the percent of full-time equivalent workers employed at the beginning of the year who left the company during the year for any reason except retirement. So it's important to understand how that was defined. Okay, let's do another cut of the data. And again, I want to show you several charts here that are all laid out the same, each looking at a particular measure, but we have a data for companies that are over 100 million in size and companies that are under 10 million in size, as well as all firms. And so before tax return on net worth is what we're showing in this chart, and you can see that the companies with over 100 million in sales volume size were more profitable than the smaller companies. And all companies overall were somewhere in the middle. Bottom line profits on sales, the high profit company, or the large companies were at 4.2% versus 3.1% for the typical small company, with the all firms in between. Gross margin on sales, however, after purchase rebates, favored the smaller companies. They had higher gross margin than did the large companies overall, which is kind of interesting because this suggests that it wasn't due to gross margin that led to the large companies being more profitable, both on sales and return on net worth than the small companies. So they did it through some other means, and obviously it had to be expense management. Inventory turnover favored the large companies. So even though the typical large company had lower gross margin on sales, they had higher inventory turnover, 4 times versus 3.6 times. As a result of that, they end up being very close in terms of their overall GMROI, which is the combination measure. So the large companies had lower gross margin, higher inventory turnover. The small companies had higher gross margin, lower inventory turnover, but their return on their inventory investment was very close to the same. Again, looking at our employee turnover number, the new ratio this year, I think it's interesting that the big volume companies had significantly higher employee turnover than the small companies. And I don't know particularly what the reason for that is, but the differential is certainly significant, so it's worth noting. Okay, as I mentioned, I want to take a look at the high profit companies. And I want to look at that specifically because by looking at the high profit companies, we can learn what leads to their high profitability. The numbers may change each year, but there is a consistency from year to year as to what leads to high profitability in the industry. Hopefully, you're already among the high profit companies. But if not, it's useful for you to compare your company versus these profit leaders, if you will, so that you can see how they're different than you. There certainly will be some ratios that you do better than them, but there are going to be some ratios that really what leads to their high profitability, and that might be areas that you might want to focus on in your own business. Okay, so now I'm going to show a series of charts that are laid out the same, and we're going to take a look at all plumbing supply companies versus the high profit plumbing supply companies. And we're going to look at all PVF companies versus the high profit PVF companies. And each chart's going to be one different measure. This happens to look at sales growth from the prior year. And just looking at these comparisons here, we can see there wasn't a huge differential in terms of sales growth in either group, either the plumbing supply or the PVF companies. The high profit and all plumbing supply companies were fairly close, and the all PVF and high profit PVF companies were fairly close. So not a big significant difference there. Return on net worth was significantly different between the two groups, not surprisingly, because we're defining the high profit companies as high profit. Now keep in mind that since I'm showing all plumbing supplies versus the high profit, the differentials in some of these measures would be greater if I would have just simply done the high profit companies and the low profit companies. In other words, the upper 50% most profitable and the lower 50% most profitable. But I'm showing here all companies versus the high profit. Okay, bottom line profit on sales. This is a big differential. The high profit companies, both in all plumbing supplies and PVF, did much better in terms of bottom line profit on sales than did all companies overall. So that's a big driving force as to what leads to their high profitability. So we need to explore a little further and see if we can identify what some of the components of that are. And first we might want to take a look at gross margin or gross profit. Those are interchangeable terms. And this is looking at it our new way after purchase rebates. So this is sales minus cost of goods sold plus purchase rebates to get gross margin after purchase rebates. And interestingly, if you look at the plumbing supply companies, all firms and the high profit companies were absolutely identical in terms of their gross margin. So it wasn't gross margin that led to their high bottom line profit on sales. The PVF companies did do somewhat better, the high profit companies, than did all PVF companies overall. So for at least the PVF companies, higher gross profit or gross margin was somewhat of a factor that leads to their high profitability. But in both cases, a huge factor is operating expenses as a percentage of sales. The high profit plumbing supply had operating expenses 22.4% of sales versus 23.7% for all plumbing supply companies. And if I looked at low or high profit versus low profit companies, this differential would have been even greater. High profit PVF firms had operating expenses of 20.8% of sales, all firms 21.6%. So again, a significant differential, especially when you consider the typical distributor has fairly thin bottom line profit margins. So if you add 1% or 1.5%, whatever it is here, to the bottom line, just by doing a better job of managing your expenses, that's by definition going to have a significant impact on your overall profitability. And when I refer to expenses, though, keep in mind, I'm not saying just go out there and cut expenses. That would do more harm than good. What I think is happening is the high profit companies just do a better job of being more productive, more efficient, and that leads to lower expenses as a percentage of sales. So when you think it through in terms of your own company and apply this to your own company, if you see that your expenses are out of line, significantly higher than companies most like yourself in the industry, that should raise some red flags. And it should lead you to look at some of the various components of expenses. And I picked here just 3. There's several others also in the study. I'm looking here at general administrative expenses, occupancy expenses, and warehouse expenses. And if you compare the high profit company versus all companies overall for our 2 segments here, the high profit companies do a better job of expense management in each of these areas. For example, G&A expense, high profit companies 7.7% of sales, all companies overall 8.3%. Occupancy 2.9 for all companies, 2.5 for the high profit, and warehouse 3.2 versus 2.9. So it's not necessarily significant differences in any of these categories, but the cumulative effect of small differences in a number of categories have led to their their much lower bottom or total operating expenses as a percentage of sales. And the same applied to the PVF companies as well. This is a consistent finding that we see every year as we do the study. The high profit companies have better expense management. Inventory turnover, which is cost of warehouse goods sold divided by average inventory. You can see a big differential in terms of the high profit plumbing supply companies. which is interesting because remember that the plumbing supply companies had exactly the same gross margin on sales. So they have much better inventory turnover, even though they have the same gross margin on sales as all plumbing supply companies overall. The high-profit PVF companies had somewhat lower inventory turnover, but remember they had somewhat higher gross margin on sales than did all PVF companies overall. Well, the net result is that the PVF companies, the high-profit companies, had higher GMROI, gross margin return on inventory, primarily because they had higher gross margin. The high-profit plumbing supply companies had very similar GMROI, but they got there two different ways. All plumbing supply companies had somewhat lower inventory turnover, but the same gross margin. And because the high-profit companies had slightly higher inventory turnover, they had slightly higher GMROI. Okay, another big one in terms of the differential between the high-profit companies and all companies overall is in payroll costs. Looking at the plumbing supply companies, payroll costs, including fringe benefits, were 14.7% of sales. All companies overall, 15.7%. So huge difference there. Also a difference for the PVF companies as well. So again, it's coming down to expense management. The high-profit companies do a better job of expense management. Sales per employee, they also do a better job of managing their employees in terms of utilizing their employees to generate and service their sales. High-profit companies were at 470. High-profit plumbing supply companies were at 474,000 versus 427. The high-profit PVF companies had $633,000 of sales per employee versus 581. And again, as we go through this, think it through in terms of your own company. What were your sales per employee? How did you compare to all companies overall as well as the high-profit companies? Inventory turnover. Interestingly, the high-profit plumbing supply companies were slightly higher in terms of inventory turnover than all plumbing supply companies. And in PVF companies, the high-profit and all were exactly the same. So it wasn't a big differential there. So I guess I would conclude that unless it's a huge differential for you and your company, when you compare your numbers versus this, it doesn't seem to be a big differentiating factor that leads to the high-profit companies being high-profit. Average collection period on receivables, well, it was somewhat lower for the plumbing supply companies that are high-profit and slightly higher for the high-profit PVF companies. Financial leverage, how much you rely on debt versus equity financing. In both cases, the high-profit companies were somewhat lower in terms of financial leverage, somewhat lower in terms of reliance on debt versus equity financing, but not significantly lower. Okay, well, what are some of the conclusions of looking at the high-profit companies? Well, there wasn't a big sales growth advantage, at least in this year. Some years there is, but this year that's not the case. Obviously, they were higher. The high-profit companies had higher profitability. That's how we define them. They derived a significant amount of their higher profitability from higher profit margin on sales, higher bottom line profit margin on sales. But gross margin was not that significant for the plumbing supply companies. It was higher for the PVF companies, but not for the plumbing supply companies. Inventory turnover, on the other hand, was higher for the plumbing supplier companies, but lower for the PVF companies, PVF high-profit companies. Gross margin return on inventory was slightly higher for both groups. Sales per employee was significantly higher for both of the high-profit groups, or high-profit companies in each group. And payroll costs was significantly lower for the high-profit companies of each group. Also, lower expenses was a big factor that led to the high profitability of both groups. Also, both groups are, in terms of average collection period, that was sort of mixed. It was lower for the plumbing companies, but somewhat higher for the PVF companies. Financial leverage was somewhat lower, slightly lower, for both the plumbing and PVF. And inventory turnover tended to be somewhat similar for the two groups. So what it boils down to, and this is a consistent finding every year, is that expense management is critical. Inventory management is important, but it doesn't necessarily come from only gross margin return or only gross margin as a percentage of sales. It's really the combination of gross margin and inventory turnover. Okay.
Tom?
Yes.
Before you get into this final section, we do have a couple of questions.
Sure.
From our participants.
Okay.
The first is, where do rebates that companies pay out get captured? Reduced sales, what's the impact on the gross margin, or is an operating expense no impact on gross margin?
Are you talking about, is it rebates on their purchases or rebates that they give to their customers? Okay, I'll answer
rebates.
both.
I think rebates on their purchases.
Okay, rebates on their purchases go into those purchase rebates. It's now a part of gross margin that reduces cost of goods sold and increases gross margin.
Okay, and on the flip side then?
If it's rebates on their purchases, on rebates that they give to their customers, that's still considered a non-operating expense item. And those aren't nearly as significant as the rebates that they receive on purchases.
Okay, we'll see if there's a follow-up. In the meantime, we'll go on to the next question. Are receivable days outstanding after the allowance for doubtful accounts, or is it for gross receivables?
It's after the allowance for doubtful accounts. It's based on your receivables on your balance sheet, and if you've already taken out any accounts that have been written off, then it's based on your current accounts, if you will.
Okay.
Anything popping up, Chris, as a follow-up?
I don't have any follow-up to that, and but maybe forthcoming.
Okay.
So let's go ahead.
It's sometimes hard to get in a discussion this way. Okay. I want to shift gears a little bit, and as I said at the outset, that something I sort of introduced last year, and I'd like to sort of look at it again this year, is what I call partners for profit, and really looking at the relationship that you as a distributor have with your suppliers, the manufacturers. That's more of a partnership rather than an adversarial type of relationship. And the whole concept here is that you have different things that sort of make you tick, if you will. A manufacturer probably wants to sell as much product to you as possible, which may oftentimes mean overloading you with inventory. You, on the other hand, want to get the best purchase price possible, so you tend to be oftentimes very gross margin oriented. So you have sort of an adversarial type relationship. But I maintain that you each have to look at sort of the long term rather than short term, and you each need to understand where each of your partner, I guess you would say, in the channel of distribution is coming from. So I'm going to take a look at where your sales dollars go, how that compares to where the typical manufacturer sales dollars go, what are some of the profitability challenges that you face that your manufacturer should understand, and vice versa. And hopefully, if you each understand that, then together you can plan what can be a profitable kind of experience for each of you. So that's where I'm heading with this. And sort of intertwined in this is what we've learned over the 32 years now that we've done this study. And the industry has definitely shifted. And let's take a look at some measures. I have here a column that looks at what were some of the average, what was the 5-year average for some key measures from 1982 to 1986. And I look at the 5-year average because obviously any 1 year can be an aberration. So it's useful to look at a 5-year average. And we compare that versus the last 5 years. And just coincidentally, both of these periods are similar in the sense that we had economic downturns to deal with and a recovery coming out of it. So hopefully those aberrations are taken out of it. But let's look at gross margin as a percentage of net sales. Now, this gross margin number is not with vendor rebates and cash discounts included within it. It's the way we did it historically. But the comparability is very useful. For the first 5 years that we've did this study, the typical company had gross margin 24.8%. Today, or the last 5 years, it's 23.7%. So there's no question that gross margins in the industry have declined over the last 32 years. On the other hand, payroll costs, and here we're looking at payroll and fringe benefits as a percentage of sales, have gone up. And they've gone up significantly over the years. So that's obviously a big impact on the economics of your business. And largely due to payroll costs going up, total operating expenses as a percentage of sales have gone from 22.4% to 24.8% for the typical distributor in the industry. So that's significant. And as a result, if you look at operating profit as a percentage of sales, and this is before adding back vendor or purchase rebates, back in 82, 86, it was 2.4%. The typical distributor over the last 5 years actually showed a 0.6% negative operating profit if vendor rebates and cash discounts are not added back in. So pretty significant shifts in the industry. Well, fortunately, vendor rebates have become more and more significant. Back in the first 5 years of doing this study, vendor rebates or purchase rebates only represented 0.4% of sales. Today, they represent 4.2% of sales. So that's significant. As a result, largely due to the fact that purchase rebates have become so significant, bottom line profit margins have basically remained the same over the 30 years. But you've gotten there in a totally different way. Return on assets, which is bottom line profits as a percentage of total assets, have also remained exactly the same. Inventory turnover, essentially the same. Gross margin return on inventory has gone down slightly because of the fact that gross margins have gone down somewhat, even though inventory turnover has stayed largely the same. So there's been these shifts in the industry, and it's important that your manufacturers, your partners, I will call them, understand what you have gone through. And further, it's important that they understand what your income statement looks like. This is a typical company P&L or income statement, and this is based on this year's survey results for all ASA companies. And a key item here is the fact that you have very thin bottom line profit margins. It's the nature of being a distributor. Therefore, you have to be very concerned about productivity. You have to watch your expenses significantly. Obviously, how you buy and the gross margins that you get are very important because they can have a significant impact on your overall profitability. But the fact is you have fairly thin bottom line profit margins. If you compare that to the typical manufacturer, the economics of their business are much different. They have much higher gross margin on sales, on their sales, and they have much higher bottom line profit margins to deal with. So every little percent of sales that you're fighting for, both in your expense management and your purchases to try to get the best price possible, has a big impact on your bottom line. And it's important for your partners, your manufacturers, to understand that. And this might be a good little chart for them for you to show them. There's other differences as well. First of all, cost of goods sold divided by average inventory, which is inventory turnover. A manufacturer has somewhat higher inventory turnover than you do. But your asset turnover is higher, typically, because the manufacturer typically has more invested in fixed assets for their manufacturing operations. Typically, a manufacturer has a higher return on assets and a higher return on net worth. So again, it's important that your partners, your manufacturing partners, recognize these differences between them and you. And it might even be useful to show them some of this information. Your bottom line profit margins are much thinner than them. Your gross margin is typically lower than them. Your operating income is negative if you don't add back the purchase and vendor rebates. Productivity is critical for you, and your industry has changed significantly over the years. Another thing I think would be useful to show your manufacturers is this little chart that you may have seen me present before, which is a very simple way of looking at your business. Let's say you start off with $1 million of cash, and you use it to buy products, so you now have $1 million of inventory at cost. You mark it up because you're in business to make money, so we're going to say you mark it up 20%, so now you have $1.2 million of inventory for resale. You end up selling it, and by the way, this 20% is not gross margin. This is just markup. If you sell it for $1.2 million and make $200,000 of gross margin dollars on your $1,200,000 of sales, your gross margin is actually something like 17% or something. But at any rate, you sell your product, so you now got $1.2 million of sales. Now it goes back up to the top if it was a cash sale for $1.2 million of new cash. It's probably not going to be a cash sale, so it becomes credit sale or receivable. Once it's finally collected, it goes back to the top as a new $1.2 million in cash. So the point here is, from your standpoint, if your manufacturer wants to load you up on inventory that gets stuck here, not selling, that's money that is crimping your cash flow, hurting your profitability, and it's money that can't go through the cycle. Also, from their standpoint, it doesn't matter what your gross margin is, and this is markup here, not gross margin, but it doesn't matter how much you mark it up. Again, if it's not selling, it's money that's not going through the cycle. So it's really the gross margin and the inventory turnover together that's most important, and that's what the measure gross margin return on inventory gets to. As an aside, if it gets stuck here as receivable that's not being collected, that's also going to hurt your profitability. It hurts you in terms of cash flow. It also hurts you because if you have too much inventory, it's going to cost you. There's various inventory carrying costs, and you can put in whatever numbers you want into this chart, but it could theoretically cost you as much as 20 to 25% of the value of your inventory. So if you have $100,000 of excess inventory, it might be costing you $20,000 to $25,000 just in inventory carrying costs alone. Another way of looking at your partnership is to look at incremental sales. And I don't want to spend a great deal of time on this because I'm getting to the end here. But if you have $10 million of sales, an 80% cost of goods sold, therefore a 20% gross margin, we'll figure your variable expenses at 8% of sales for our little illustration. So you have $800,000 of variable expenses, and just for simplicity, let's say your fixed expenses at this sales volume level are also 8%. That would leave $400,000 to the bottom line in the way of profit, or 4% profit. If you can figure out some way of generating $1 million of new sales, and I'm not talking about cutting prices, but can generate new sales of $1 million, and that's where your partners come in. That's where your manufacturers come in. If they can somehow do advertising or create product awareness that creates that for you, then you're going to benefit. Well, that's a 10% increase of sales. We're going to say that you got that without having to cut prices. So your cost of goods sold is $800,000. In other words, your gross margin is still 20%. The variable expenses go up with sales, so we're going to assume that goes up about 8%. But the fixed expenses stay fixed over incremental sales increases. So as a result, on the new million of sales, you dropped 12% to the bottom line on the new million of sales. So that's $120,000 of new profit on the new million of sales. So the idea here is, if your partners can somehow generate this, help you generate this additional sales, you're going to benefit. So just sort of summarizing, then this partnership approach is much different in the sense that it's not adversarial, it's an understanding of each other and trying to set goals together. And if you can achieve that, then you're going to probably benefit. And finally, how do you use this information? Well, start off looking at key measures. Start off looking at the comparisons of companies most like yourself. If you see areas that are out of line, then let that dictate other things to look at in more depth. And where do you put your emphasis? Well, I would start off looking at some of those things that separated out the high-profit companies. That seems to be expense management, personnel management, inventory management, and if you focus on those areas, that's going to probably give you the biggest bang for your buck. As a participant, you received both a letter and an email on how to access your secure information. The link is shown there on the screen at the bottom. If God forbid you didn't receive either the letter or the email, contact me and we'll find out why. But it only went to the person whose name was on the survey questionnaire as to the person who was to receive the information, obviously because of confidentiality. So if that's not you and you contact me, there's not a lot I can do to help you. Chris, are there any other comments that come through that I can answer? I'm a couple minutes over here.
Yes, just a couple.
Okay.
First, do the collection days include cash sales as part of the sales number in the calculation?
Good question, and the answer is no. They're taken out.
Okay, and then going back to the rebates paid out to customers, what wholesalers pay out to customers. We have an attendee suggesting that rebates paid could be captured because these are she thinks these are equally as significant as rebates received. And having one in gross margin and the other in operating expenses can distort the financial results. How do you respond to that?
Yeah, I agree with whoever asked the question in terms of the seeming inconsistency, but we've kept them down in the definition for how to fill out the survey form. We've kept those down in the non-operating expense item where they have been in the past, and they still only represent, they're still non-operating expenses with those plus other things that are in non-operating expenses still only represent 1.3% of sales. So they're nowhere near as significant as the purchase rebates. So, you know, they could easily be put into another expense category, but they're not nearly as extensive as purchase rebates are. And again, if we were in a seminar situation, that might raise more questions and we could discuss it, but they really aren't, they're probably less than 1% of sales for the typical company.
Okay. Well, why don't you go ahead and move to the next slide with your contact information.
Okay.
And we'll wrap this up. We'll give people just another minute to pose any additional questions as we conclude the program.
Okay. I would encourage you to send an email to me or call me if you have further questions. Like I said, a webinar is a little bit limited because we can't get in the same kind of discussion as we would if we were face-to-face, but by all means, feel free to do that.
Absolutely. It's these kinds of questions that help us to fine-tune this study, and a great example is the employee turnover metric. You know, it started as a simple question, and then we worked with the member that had posed the question to craft, you know, how we might calculate that information and then include it in the report. So the input is always very helpful. And
yes, and we always want to evolve it, needless to say.
So with that, thank you, Tom, for an excellent presentation, and thank you, everybody, for participating in today's webinar about the American Supply Association's 2014 Operating Performance Report. Again, this webinar has been recorded for replay, and all of you will receive a follow-up email message with notification as to when the replay is available, as well as instructions on how to access it and the presentation slides. Lastly, there's still time to book a room and register to attend Network ASA 2014 at the Bellagio in Las Vegas on September 9th through the 11th. With nearly 110 wholesaler firms already registered, we have surpassed the goal of having 106 distributor firms represented, and all indications point clearly to a very successful convention. Please visit www.asa.net for complete information. I'm Chris Murin with ASA, and this webinar is now concluded. Thank you and good afternoon.